Okay, welcome everyone. Thank you for joining us today. I'll be doing the business tax structuring webinar. We'll shortly be commencing that. We'll just allow some more attendees to join before we begin the proceedings of what is going to be an action-packed webinar with loads of useful content for you today, which has been put together by myself and my colleague Chris, who you can see on screen today. The webinar is hosted by Fusion Consulting Group, which is the company I co-founded 7 years ago, and we are a professional services group, also an award-winning tax firm. So thank you very much for your time. We're aiming to get through today's webinar in and around 40 minutes. There will be time, hopefully, for a Q&A section towards the end. So if you do have any questions in specific to tax or financial advice, or anything business related, please feel free to post them in the chat function as we progress throughout today's webinar, or indeed if you're viewing on social media, you can put your questions in the comment section and we will address them towards the end. Obviously, when we're dealing with personal finance and taxation, there could be pressing personal questions which you may not feel right to publicize, and you'll see our emails and contact addresses on screen, so feel free to reach out to us and we'll happily arrange a consultation for you. So as I mentioned, today's webinar is brought to you by the Fusion Consulting Group. So what we've built here is a company designed for business owners and entrepreneurs. So not just focused on taxation or financial advice, we've created a multidisciplinary professional services group so that round the table for a busy business owner and entrepreneur, they have their key advisors working day in, day out for them. So we have in-house accountants, tax advisors, lawyers, financial advisors. We've got digital marketeers, legacy planners, all in-house working to save you, the client, the business owner, time and money. As a thank you, we always offer a consultation to our attendees today. So we appreciate you investing time in what we're saying. So what we're going to be offering today is a free 360 consultation for anyone who is attending today. So what that means is that we will have a meeting with myself, my colleague Chris, maybe one of our legal advisors, Alex, where we will talk about your business, answer your questions, and give you some initial general 360 advice. We call it 360. So if anyone would like to take me up on that offer, all you have to do is send me an email with free 360 consultation in that email, and we will happily arrange that for you. It'd be our pleasure to speak to as many of you as possible today. Okay, so here's the agenda. Really exciting. So we've done the intro. So just to recap, my name is Mitch Young, known on social media as Mitch the Taxman. So if you'd like to follow me, that's my social media tag there, Mitch the Taxman. Set up the business along with my business partner 7 years ago. Also on today's webinar, and you'll hear from him a bit later, is Chris Wilding, who's one of our financial advisors. So in terms of the agenda, I thought it'd be quite useful just to recap on the budget or mini budget or absolute mess or whatever you want to call it, chaos that's going on in the UK. So we'll just recap on that to begin with. I'm then going to be looking at corporate tax structuring, particularly around what is a corporate group and the tax benefits of doing that. I'll then come on to discussing employee share schemes, the tax efficiencies of those, why they're so popular at the moment, and why it's so important as a useful mechanism to retain staff. We're then going to go on to corporate tax reliefs, in particular the research and development tax relief, and then finish off on the tax side with a very brief overview of how a family investment company fits into your corporate tax structure. I'll then pass you on to Chris, who will talk about financial investment protection through your business, because of course it's important not to silo on tax, important to look at what you can do as a business owner from a financial advisory perspective. And we'll then finish off with some Q&As. So aiming to whiz through in around 40 minutes. Appreciate it's going to be fast, it's going to be frantic, so sit back. Hopefully you've all got a drink, and we'll go from there. It's just a quick slide on our tax division. Obviously anything relating to tax we're able to handle here with Infusion, from tax advice to compliance. Most people come to us because they've never received a written tax strategy, and we write that strategy, the corporate tax strategy, and linking that into obviously the business tax strategy. One thing we have been doing a lot of is RAG reports, so analysing the corporate accounts and seeing whether they've claimed everything possible. Okay, so obviously we've all seen the news. We've all been through the roller coaster of the budgets, or the mini budgets, or whatever you want to call it, from the Chancellor to the new Chancellor, with Liz Truss obviously behind everything, making a complete mess. So we had a number of tax cuts that were coming in. We produced some marketing on those tax cuts, but obviously what was announced yesterday is the total, pretty much reversal of all those tax cuts. So just to summarize in terms of what's happening, or indeed what's not happening. So the dividend tax cuts that were mentioned, are now not going to be there. So essentially the dividend rate is going to be at the additional rate of 8.5%. From the starting perspective, 33% from the basic rate perspective. The IR35 rules, which were very interesting, particularly for contractors, whereby the ultimate responsibility was with the top company and not with the contractor from a tax perspective. They were reversing that, so the ultimate responsibility would be with the contractor and not the main company. That's again now been wiped out, so there'd be a continual responsibility for the top company, which is usually the main company or a bigger organization, that they will have the responsibility for tax. So that's happening, not happening. The 45% additional rate of tax, of income tax, will remain as it is. Basic rate of income tax will remain as it is at 20%. Energy price guarantee, not that it's so related to tax, that's going to just go through until April 2023. And finally, what is, I guess, some relatively good news from a sort of tax relief or a tax perspective, is that the annual investment allowance, so that's the amount in which the company can spend on capital expenditure and get relief on that, will remain at £1 million. So that's a piece of good news there, I guess. I have had a number of calls from the government to get involved as the new Chancellor, but I have rejected them at this point. So what we do a lot of is we act for loads of entrepreneurs and business owners who typically come to us and say, look, we're paying this huge amount of tax because we're taking out dividends. Is there any better way in which we can structure our matters? And typically what we find is that a business owner may want to take money out of their company because they would then want to invest in, say, real estate, or maybe another business, or whatever it may be. And having to take out or draw out dividends will mean that there's additional tax, income tax to pay. So what we look at for the right individual and companies is, can we align all their companies together and create what's called a corporate group? So the idea of the corporate group is that rather than having you as a business owner individually own a number of entities, so you may have your trading business over there, you may have property business, you may have investing with your friend over there, what we do is essentially look at establishing a holding company for you, and that holding company will then acquire the shares from you in all your other entities. So let's say, for argument's sake, you've got your trading company over here. You've got your holding company set up. That holding company would acquire the shares from you, and now the trading company is owned by your holding company. Then what you can do is, instead of paying you as the individual a dividend and having to pay income tax on that dividend, you essentially can pay a dividend to your holding company without any tax, because there's no tax on corporate groups or dividends to a corporate entity. And then once it's in your holding company, you then may want to move it down into a property company or a new venture or whatever it may be for continual investment purposes. Now, obviously, that sounds very, very attractive, and it's a way of being efficient with your monies, with your profits. And it's a way of just paying corporation tax around the group and then being smart with your money. In order to set these things up, there is obviously a bit of a process. Other things you may want to consider is not just for the movement of your monies within the corporate group. Other benefits of a corporate group are things like, debentures, in having the different entities. It may be, you may want to, if you've got certain different companies, you may want to have a cost center in one of the companies and essentially split out costs, or for organization purposes, a lot of companies will have a centralized company just for their shared costs. If one of the companies actually start to make a loss, then what you can do is benefit from the corporate group loss relief as well. And then other things I've put on here, like additional pension contributions, could be another positive in establishing a formal corporate group tax structure. So there is a bit of a procedure to do this, and the key thing is it all has to be done from a commercial perspective and not from an anti-avoidance perspective. That means you can't just artificially create corporate groups between just for tax reasons. So there needs to be a commercial reason to it, and the process is as follows with HMRC. You have to apply for non-statutory clearance. Well, you don't have to, but it's certainly advisable in something like this to apply for non-statutory clearance with HMRC. And that process involves obviously quoting the necessary the legislation, going through the transaction in terms of what's happening, the commercial reasons, drawing the diagrams before and after, and creating the business case with HMRC. Once you've done that, you send that to the reconstruction unit at HMRC, and they will respond accordingly, ideally to rubber stamp the transaction, and that means you've got there, it's been rubber stamped, and you can move forward and create your structure. Essentially, what we're finding is that HMRC response times have been pretty good recently, particularly in the reconstructions unit. We probably do around 3 to 5 a week, different reconstructions, corporate reconstructions, and essentially we are seeing response times of around 7 to 14 days on this, and that's really good. I mean, before the pandemic, and even during the pandemic, it was taking weeks, if not months. And now that response time we've been really pleased with. Also, the appetite from HMRC is different to what it was. So previously, you could just do a small briefing letter, and it's likely HMRC would approve it. Now you've got to build the business case. We're pleased to say we have a very good track record in doing that with HMRC. But once you've got that, obviously you can go ahead with the necessary company's house adjustments, shareholders adjustments, and then move the dividends and funds around the group accordingly. What was I going to say? The other thing that you need to look at, obviously, not only from a tax perspective, is obviously the legals, updating the shareholders agreements, or indeed doing a new shareholders agreement, and the necessary legals with setting up something like this. In terms of cost wise, well, obviously it's a bit of a cost to go through. You're probably looking, if you're looking at the legal agreements, the tax work, the HMRC work, you're probably looking in and around the 10K budget mark to actually achieve this. So we've got some question. I'll just address one of the questions before we move on. So I've seen there's loads of comments on social media. So thank you all for joining. If you are liking today's webinar, please do like, comment, share. Let's try and get to 1 million views. The difference between the loans and the dividends, essentially what you're looking at is, having too many associated loans within your business can result in it being deemed as an investment activity, and that could create issues further down the line. So that's one of the key areas. The other is, depending on what you're looking to do with the business in the future, a lot of the entrepreneurs that we deal with, they're essentially going to be geared up to look attractive for a trade sale or some type of sale. So, you don't want too many outstanding loans within the intercompanies, and you want it nice and clean. So, there's sort of two specific reasons there. Okay, moving on. Sorry, we've got loads to cover. So, moving on. For all the business owners who are watching today, or indeed listening on the recording, know that in today's market, recruitment is very challenging, no matter what sector that you're in. And one of the key things that one can do is in order to incentivize key members of their team, is by offering employee shares. And what HMRC have done is that they've approved a number of options to a business, which makes it more tax attractive to give your employees shares. So we're going to look at one in particular, but what we've got here is you've got a number of HMRC approved share schemes, and then you have unapproved share schemes, which essentially anything that's not HMRC approved. There's 4 HMRC approved share schemes, and they are EMIs, SAYE, CSOPs, and SIPs. And essentially, there's a process in order to get qualified for these schemes, get registered with HMRC. And once you're registered, you can then issue the shares. You can put together your necessary documents internally, so your legal documents, your employee share documents, and then you can start issuing the shares. The great thing with any type of employee share scheme is, not only from a tax perspective, is that you can put in there certain conditions in terms of exit, certain conditions in terms of qualifications, and obviously you can tie people in. If they leave, they get to give up the shares, etc., etc. So there's quite a lot that you can put in there. And again, one thing what we do with Fusion is that obviously we look at the tax side and then the legal side to make sure that they're both aligned. But if we look at the EMI, it's probably the most flexible employee share scheme out there, and it's one that the majority of companies are using. It's available for companies, and particularly the size of companies that we look after, where essentially you can't have more than 250 employees, and you can grant shares up to sort of £250,000. Now, if we look at the tax advantages of this, there's no income tax or national insurance on receiving the option. So that's very important. No income tax on exercising the or national insurance on exercising the option. And the biggest, one of the biggest drivers is that you want your key members of staff to believe in the journey, and the journey is typically towards an exit. So they're going to have shares and their benefit along with the business owner from a capital exit. And one of the big points is that with the EMI HMRC approved share scheme is that the capital gain on the sale of the shares will be at the lowest rate of tax, which is at 10%. So that's really crucial. Just to note that the employee won't pay any income tax or national insurance when they buy the shares. But if you're going to give them shares at a discount, then there will be the normal income tax to pay on those because it's a gift essentially. But we're seeing loads of these being set up. We're advising on loads in the current market. And they've never been more popular. Okay, so coming on, every business owner should know, I'm sure a lot of you listening today do know about research and development tax credits, research and development tax relief, one of the best reliefs available if you've got expenditure that can qualify. It's a government-backed tax scheme. It's an incentive for a business owner, encouraging them to create something innovative in their space. And essentially what they get in return is they can deduct an additional 130% of qualifying expenditure against the taxable profit. You're likely to be eligible, and I've put this up on screen, if you meet, if you answer yes to any of these questions. Have you developed something that is outside the industry norm? Do you develop your own in-house software? Have you established new ways of working or created something that you didn't know was going to be successful on the outset? And are you an SME that has subcontracted any of the above? So if your answers to that is generally yes, then you've probably got a good chance of claiming the expenditure. And if you've done it in a previous year, we can also look at helping going through the claim. Now, in terms of actual going through the claim, the research and development tax claim, it is highly technical. We've got in-house technical experts who write the narrative, and you can see on screen we've provided you with an extract of the narrative. You can see the level of technicality and depth that goes into it. Essentially, the technical narrative includes details of the technological innovation, the resources used, the outcomes and challenges, the financial schedules, etc., etc. And it's very important that you're able to demonstrate to HMRC that the guidelines set for R&D tax credits have been met. And then what happens, typically takes 4 to 12 weeks to go through the process, is that you can get a refund from HMRC in terms of a check or repayment. You can look at some loss relief and carrying that back or forward against future profits. Alternatively, if you're loss making and there's no tax to pay, you can essentially look at claiming some of the loss back as a tax repayment. So R&D is good, even if you might not be in an industry that has created nothing really scientific, but has created something new or invested in new software. Then it's just worth exploring because it's a very generous relief. Okay, and finally on my side is looking at what we do a lot of is looking at a family investment company that may sit above the overall holding company. It may be the holding company itself, But the whole idea of a family investment company, and essentially what you may have is that you may have two groups. So from a corporate perspective, so you may have your trading group over here, and then you may look at setting up a family investment company, or you may have the family investment company involved with the trading group. But with the family investment company, we're looking at a lot of personal assets. You're looking at personal wealth and mitigation. And the idea is an alternative to a trust structure. Trust structure is very important to use within your arsenal in terms of legacy planning and protection. But with the family investment company, essentially what it is it's a limited company which is governed by the shares agreements and different classes of shares. So typically what happens is the parents subscribe to the Class A shares and the children to different classes of shares, which give them different voting rights, give them different rights to dividends, etc. The parents put in the director's loan. The company then invests in investments, property, whatever it may be, and the income and the growth in that the parents take back via the director's loan. And the growth of that investment, because the children already own whatever percentage they may own, 48%, that growth sits outside the estate because it's already in their 48%, whatever it is. So it's a continual type of strategy. I'm obviously making it sound very simplistic. There's a lot of legal and compliance that goes around it, but that's essentially the theory of using a corporate entity within that. Of course, what we're doing is, again, sheltering the rates of corporation tax as well, using dividend allowances and things like that to come up with an effective tax solution, which encompasses inheritance tax, corporation tax, income tax, and the use of a corporate vehicle. As always with taxation, there's so much going on. There's so much opportunity out there. It's about understanding your options and what you can and can't do. And that's what we pride ourselves on. We pride ourselves on writing tax advice, writing tax options for the business owner so that they can get to the ultimate solution. So I'm now going to have a breather. I'm going to hand you over to my colleague, Chris, who hopefully hasn't fallen asleep after listening to me. All right, he's still there. That's good. Yeah, I'll hand over to Chris, who will introduce himself and take you through the next part of the presentation today.
Good afternoon, everyone. Good to meet you. If you haven't seen me before, hi. If you have seen me before, then it's something new might come up this time, which you might not have heard last time. So obviously we've heard everything tax-wise from Mitch about what you can do with your business and how that works. Whether that be a restructure or whether that just be within the business itself. But the title here, more than just your job. I mean, the whole point that we have these businesses in the first place is obviously to build up your own wealth, to do things for you and to make your business work for your circumstances. So we'll talk a little bit about how you can use your business to do things like that, such as protect your family, and just generally increase your wealth through a tax efficient way. So that's what I'm going to cover here. So we've got our first one, which is this tax efficient protection. Now, quite a lot of people have life insurance in some way or the other. Quite a lot of people don't. We highly recommend you have some in some form, but if you're going to do that and you're paying it personally, then I highly recommend you consider potentially doing it through your business. The reasons being that it's a little bit more tax efficient. So if you're paying a premium for an insurance policy through your business, then obviously it's coming off your profit because it's a cost. Reducing the national insurance contributions that you would have paid had you wanted to take the money out of your business. It was salary, but obviously more likely, guys, to be dividends, and same with the income tax. That's more than likely to be an income tax, but a dividend tax. But the point is, you're not having to take the money out of your business first and then pay an insurance premium. You're paying it through your business, counting it as a cost, reducing your corporation tax bill, and then obviously getting all of the benefits. There are ways to do that. We help set up these policies and do that on your behalf. So it's very, very efficient to do. So if you've got life insurance currently and you want to consider these options and something reasonable, then please do reach out. An example here. So If you've got ordinary life cover, you've got your employee national insurance contributions. I've assumed an income tax of 40% here, national insurance contributions for the employer. And then obviously once you've got that amount, you're going to pay corporation tax before any of that. So you end up paying for £1,000 per month worth of premium, a net cost of £2,335 to do that where you're doing it personally. Whereas if you've done something called a relevant life plan, you're getting the reduction for corporation tax, 19% obviously, but we know, guys, it's going to go up to 25%. So an even bigger saving to do it that way, and just no other taxes involved. So it's super, super efficient. So I highly recommend it. And again, private medical insurance, this is becoming so much more common. Personally, if you have experienced the NHS, it's in a terrible state at the moment. Sadly, we hate seeing it, but waiting lists are going through the roof. I saw 12 months plus for major surgeries, which is shocking in this day and age. So people are opting for private medical insurance in one way or the other, and one of the best ways to do that is to pay for that through your business. Again, it's a cost to your business to provide something to yourself. You can add your family, you can add your partner, you can add your kids, you can add your other staff. I mean, at the moment, we're setting up so many private medical insurance policies for businesses everywhere because they want to attract more staff to the business, or they want to give their employees something to retain them. And it's super cheap. Essentially, it works in the way that the underwriting spreads that risk across the whole business. The more people you have on it, the cheaper the premium for each of you. So, adding your employees to your PMI could make your PMI premiums cheaper. And you can do several tiers. You can do something really, really nice for yourself, and then a core tier for other people. They come with discounts, benefits, etc. So if you're in the position where you're thinking, God, we need more people, but we can't seem to get them, or, why do people keep leaving? I would highly consider getting in touch, and we can set you up a PMI scheme. You'd be surprised at how cheap it can be. But yet, again, this is another one, even if it's just yourself, potentially doing it through the business is highly effective. So one thing that it's on a daily basis, I have conversations with clients about this, is pension contributions. If you own a business, you should probably be doing it through your business. There's various rules that you've got to consider here, but you have your business to increase your wealth. It's not just in the business itself. And, if you're taking money out of the business, why not do it through a pension contribution? It's a cost to the business, again, saving you corporation tax, which obviously 25% now or next year. You're not paying any income tax at all or dividend tax to take it out of the business. It's going straight into the pension. At the same time, once it's there, it's totally inheritance tax free. That's a 40% tax saving just by putting the money there. Which is incredibly attractive in the grand scheme of things. And quite a lot of the time I meet people at sort of 50, 60, 70 who say, I want to do some inheritance tax planning. And I say, well, have you considered pensions? And they go, actually, no, I know I have them, but I've not done anything special. And I said, well, why don't we consider making some greater contributions? And while you're working or while you have your business, the best time to do that. And quite often, people have these savings that could have been into the pension years ago, growing, getting substantial growth on that. So highly recommend at least having the conversation now to see whether that's worthwhile. Again, these are things you've got to be careful of when you do contributions. So everyone has an annual allowance. Quite often people they retire and then go, oh, can I do a pension contribution? Then suddenly your ability to contribute is massively reduced. Hence why I said, it's important to do it while you are owning your business or earning of some type. It's very important. The lifetime allowance, this is to stop multi-millionaires from putting millions and millions into pensions because it's such an attractive tax scheme. This is a good problem to have in some situations. If you're at risk of paying 40 or 45% tax on income, and yet if you go over the lifetime allowance, which is the LTA, you'll pay a 20% charge. That's still a 20% increase or a 25% increase. So sometimes it can be a good problem to have. So don't let it scare you. Talk to an advisor if you are considering or you're close to your LTA. We'll be able to tell you what makes sense. People can be tapered. If you're earning ridiculous sums of money, then you can have your annual allowance reduced, which means you can't contribute as much. It's not a bad thing. Sometimes we can even return to the taper or the pre-taper amount if we plan things correctly. So if you've heard that word before from your employer or from your accountant, then please have a conversation with us. We can potentially improve that situation. And obviously, the golden rule with pensions is it's a long-term investment. You can't access it before age 55, which will soon increase to 57. So this is long-term money. It's going to go to your kids, or it's going to definitely be there at retirement for you. So that's a major consideration to have. So people often say, "Oh, yeah, I'll contribute to a pension," but then you're stuck about what to do, which is absolutely right. You should have a good pension. To find out what that means, I suggest we have a chat. But essentially, it means that you're contributing to something that's going to grow greater than everybody else's pension in some sort of investment way. So quite a lot at the time, people compare a pension contribution to something like property, and they use that red line as an example of the pension. It's just simply not the case. This is highly likely that you're able to beat the market by a substantial way if you're doing it in a smart fashion. You can see the blue line. That's a popular fund that did incredibly well, and you see the peak at the top there. That's when we stopped recommending it and told clients to move out of it. So we banked that and went into something a little bit more defensive compared to inflation. And we've done very well. I think we beat on our balanced portfolio, we beat the market by 6% this year alone. So if you're smart about it, you can do very, very well in a pension if you talk to people like us. So highly recommend it. So obviously this is a bit about us at Fusion Financial and everything we do. I say it's pretty holistic. We look at the whole picture. We make sure that everything's covered. If you're doing one thing, how does it affect another? And obviously, if you're having a conversation with Mitch at the same time and his team, we take into consideration everything that's going on. We're able to talk to them. They're able to talk to us. And we can come up with that whole plan. Like Mitch said, you've got that free 360 initial consultation. I suggest you take us up on it. Really can be informative when all the brains come together in one place to come up with the method. So highly suggest it. And of course, this is the 360 advisory position. It's invaluable. That's the reason why we're here, just because it's so great for clients. Perfect. So just any other questions, please put them in the chat. Happy to answer them, and Mitch will get through the ones that we've already got here. Anything else, or you want a consultation, please do email me, chris@fusionfinancial.co.uk, and we'll have a further chat.
Yeah, nice one. Yeah, thanks, Chris. Really great stuff. And thanks everyone for their patience today. We're bang on 37 minutes, so that's truly efficient. We've left a few minutes for questions. So obviously, we just so everyone knows, we're filming on social media as well. So anyone who's watching on social media, if you have any questions, please feel free to now put them in the comment bar, and that could be relation to tax or financial advice, or anything to do with our company, which is the Fusion Consulting Group, how we work. There's been quite a few comments and questions around, is the presentation being recorded? And yes, it is. And everyone that's registered will be sent an email, I believe, tomorrow morning with a link for the recording. So if you're using the recording to listen and gain some information on what we said, or if you're just using it to get yourself to sleep, either way, we're glad to be of assistance. We've had some comments around loans, which I think we've covered off as well. So yeah, any other questions? We'll hang around for the right time. Some questions on social media. Holding company and corporate group are the same thing. So yes, similar in the sense of, a holding company essentially will own the shares in the other companies. Whether you've got a formal corporate group is essentially, two or more companies which are associated by a common shareholding. So yes, it's similar, but not quite the same. Got a question here, Chris, if you can see that one.
Sure, is that from Paul?
Yeah.
So, Paul, the limit that a company can put into a SaaS pension. This goes back to the annual allowance, which typically is 40,000, but like I said, can differ depending on your circumstances. So have a chat with me. We can calculate it for you exactly what you can put in every year. You can do things like carry forward as well for past years. But if you're making an employee contribution, it can get sticky. You can do sometimes more harm than good. So let's have a chat on that. You're talking about the 500,000 there. No, not sure what that's in reference to, but I believe that it is just the 40,000. So the 500,000 is more likely in reference to something like the LTA. I suspect if you've read that off Google or anything of the type, it's more the 40,000 figure you have to think about.
Okay, thank you. So we've got some questions coming in. Employee share schemes. How would I, as an employee, convince, if you will, to join one of those schemes?
Okay. So you mentioned employee share schemes. Yeah, this is probably your field, Mitch, I guess.
Yeah. Sorry, I was just understanding the question. I wasn't sort of posing it at you.
Yeah.
How would I, as an employee, convince, if you will, to join one of those schemes? I think what you're saying is, how will you convince the owners of your business to set up a scheme? Do you interpret it like that, Chris?
So it's generally a good thing if you're an employee. So if you're talking from an employer's perspective, it's generally a good thing for employees, because obviously they're getting
convince my employer. Yeah.
Share of the profit. So it shouldn't be too hard an ask if you sit them down and say, I want to give you something.
Yeah, I think as an employee, as an owner's point of view, depends, obviously on the journey and what it actually means to them, and how valuable a staff member you've been. If you've been at a company for a long period of time, you've helped grow the company, you've been an invaluable asset, then I think in your next review or go out for dinner or whatever your relationship you have will be saying, look, I'm really I love working here. I believe in the company. I feel the company's part of me. I'd like to consider one day getting shares in the company. How do you feel about that? Is there any plans to create an employee share scheme in the future? If you want to have me in your ear as you're having the dinner, we can see if we can arrange that.
Okay, so Bernard, key person life insurance through a business and in the corporate structure changes in the future, e.g. fold the limited company and join another, can you move the policy across entities? Well, first of all, the answer is yes and no. So key person's a bit funny. The key person is something you'd normally take out on someone important in the business. So say if Mitch thought I was important, he'd take out key man cover on me, because without me, the financial advice sector would be harder hit, because obviously I'm not there to talk to clients. He'd take out key man life insurance on me. You're potentially looking at other things like relevant life or just business term. And yes, those ones can definitely be transferred over. So you can say, look, Mr. Employer, I would ideally like to pay this personally. Now, if obviously the business folds, you can do that. I mean, at the end of the day, the life insurance provider is happy as long as someone's paying those premiums. They've taken the gamble. They're saying, look, we think you're not going to die. This is how much we think you should pay us to do that. So if you pass away, obviously it's that point where they go, oh no, but it's in their calculations. So they're normally happy for you to take it over. But just the fact of key man cover, I'd say let's have a conversation and make sure that you're setting up the right things for the right people in the right way, just to make sure.
Yeah. Okay, we're going to have one more question. So get them in quickly, but the one here is in regards to, you've got a company, you've got losses, you've got an associated LLP, and essentially how will that essentially be look like from HMRC in terms of I guess aligning the two businesses with a view of them potentially claiming a loss across the business. HMRC don't particularly like that. I don't think that you could you could achieve that in the current format. So I think it is likely to be turned down for the utilising of the loss. In terms of aligning the business and trying to create some type of alignment and corporate group, then yes, there could be options around that. But certainly in relation to the loss and the utilisation of the loss, I think there would be an issue there. Got questions online. Can I pay a corporate dividend for my UK company to the holding company if it's abroad? Yes, that should be okay. Okay, well, look, we really appreciate everyone's time today. Thanks for Chris for his time, as always. As mentioned, the recording is available. So for those who aren't registered and following on social media, the link is in my bio. So click on the link, register, and then you'll get the recording in tomorrow's email. We'd welcome the opportunity to have a conversation with any entrepreneurs and business owners who are listening today. We are set up for you. We can become your private office, or even if you just want to have a chat to assess your current circumstances. Myself, Chris, our lawyer, our accountant, our business advisor, we can all be on the call. We're ready to go to help entrepreneurs save time and money. And that is what we're here to do. All you need to do is email me. We can arrange that 360 chat and be our pleasure to speak with you. If not, of course, we're running monthly webinars. You're all part of our ecosystem. So our next webinar will be in November in something topical regarding tax and finances. So I hope to see you there. And in the meantime, if you're looking for little nuggets of information on a daily basis, you can follow me on social media at Mitch the Taxman. I hope you all have a pleasant day and thank you very much.
Thanks, guys. Take care.